Right now, in early 2026, the American economy looks calm. Too calm. Unemployment hovers near historic lows. Gas prices sit under $3. The stock market is posting record highs. Retirement accounts look healthy. On the surface, this feels like stability. But according to economists who track long-term risk rather than short-term headlines, this calm may be misleading. Multiple independent research institutions warn that what we are seeing is not equilibrium. It is a delay. And delays in economics usually end with a reckoning. According to reports from the Peterson Institute and Moody's Analytics, the current economic picture is being propped up by temporary forces that are already losing strength. The data suggests that the United States is not cruising towards sustainable growth, but coasting on borrowed momentum. And the timeline matters. Several models converge on the same window, mid to late 2026. That is when the buffers disappear. That is when today's decisions begin to show their full cost. To understand why, you have to go back to April 2025. Court records and official White House releases confirmed that this was the moment when U.S. trade policy changed abruptly. The administration announced a sweeping tariff regime, including a universal baseline tax on imports and extreme penalties on selected countries, particularly China. Legal analysts note that the average U.S. tariff rate jumped to levels not seen since the early 20th century. Historically, that period is not remembered for prosperity. It is remembered for economic contraction. Financial market data shows what happened next. Within days, trillions of dollars in market value evaporated. Major indices fell sharply. Analysts at major banks described the move as a policy-induced shock, not a response to an external crisis. There was no war, no pandemic, no natural disaster. The volatility was triggered by a deliberate political decision. That distinction matters because it changes how investors interpret risk. Then something unusual happened. The markets recovered. By late 2025, equities had not only rebounded but surged to new highs. Supporters of the administration pointed to this as proof that the strategy worked. But according to behavioral economists, market recovery does not always equal economic health. Sometimes it reflects expectation, not fundamentals, hope, not math. Economic historians describe this pattern as a front-loaded benefit, back-loaded cost cycle. In simple terms, policies that inject short-term stimulus without long-term financing create a temporary surge followed by delayed stress. Data from the Congressional Budget Office and independent budget models show that the current expansion fits this pattern almost perfectly. Growth is real, so are the wages gains, but the financing structure behind those gains is fragile. Legal and economic analysts point to three structural pressures that are building simultaneously. The first is trade taxation. Despite political rhetoric, tariffs are not paid by foreign governments. Accounting data and customs records show that tariffs are paid at the point of import by U.S. firms. Those firms then pass the cost downstream. According to the Tax Foundation, the cumulative effect of current trade policy translates into a significant annual cost per household once fully implemented. This is not speculation. It is arithmetic. Treasury projections initially suggested massive revenue gains from tariffs. However, trade data from 2025 tells a different story. Import volumes fell, supply chains adjusted. According to the Bipartisan Policy Center, actual tariff revenue came in far below early projections. Economists explain why this happens. When prices rise, demand falls. When demand falls, tax bases shrink. Tariffs reduce the very activity they are meant to tax. The second pressure point is labor. Immigration enforcement data confirms a sharp reduction in workforce participation in several labor-intensive sectors. Agriculture, construction, food processing, and logistics were already facing shortages. Now those shortages are acute. Labor economists warn that when supply contracts, while demand remains steady, wages rise. That may sound positive, but it feeds directly into price inflation. Higher labor costs increase production costs. Those costs are passed on to consumers. This is what economists call a supply-side inflationary shock. It is slow at first, then it accelerates. And once embedded, it is difficult to reverse without slowing the entire economy. According to Moody's Analytics, the effects of labor contraction often lag policy changes by 12 to 18 months. That places the peak impact squarely in 2026. The third and most sensitive pressure involves monetary policy credibility. Court filings, public statements, and recorded interviews show sustained political pressure on the Federal Reserve to lower interest rates. Legal scholars emphasize why this matters. The Federal Reserve's power does not come from force. It comes from trust. Markets believe the Fed will prioritize price stability because it historically has. When that belief weakens, expectations change. Bond market data already shows early signs of this shift. When investors expect higher inflation, they demand higher yields. Higher yields raise borrowing costs across the economy. Mortgages, business loans, and government debt all become more expensive. According to historical analysis by the Peterson Institute, this sequence appears in nearly every modern currency or inflation crisis. The pattern is consistent. The outcomes are not subtle. Projections from multiple models suggest that if current trends persist, inflation could re-accelerate sharply by late 2026. That does not mean inflation is high today. It means inflationary pressure is being suppressed temporarily. Companies are absorbing costs. Consumers are still buying from pre-policy inventory. Financial markets are pricing in reversals. These buffers are finite. Meanwhile, fiscal policy is adding another layer of risk. Legislative records show that recent tax and spending changes permanently reduced federal revenue without offsetting expenditure cuts. Independent budget analysts estimate that this gap adds trillions to long-term debt projections. Debt itself is not new, but the scale and timing matter. Large deficits during periods of low unemployment leave policymakers with fewer tools when conditions worsen. Economists across the political spectrum agree on one point: persistent deficits eventually force trade-offs. Either spending is reduced, taxes rise, or inflation erodes purchasing power. There is no fourth option. The delay does not eliminate the cost. It reallocates it across time and across generations. International relations experts add a geopolitical layer to this analysis. Trade partners and foreign investors are not just watching economic data. They are watching consistency. Negotiation records show repeated shifts in trade policy within short timeframes. Strategic analysts warn that unpredictability can extract concessions once. It cannot sustain leverage indefinitely. When reversals become expected, threats lose power. By early 2026, business surveys already reflect this uncertainty. Investment plans are being delayed. Hiring decisions are being postponed. Cash is being held instead of deployed. According to Federal Reserve regional data, uncertainty itself is now acting as a drag on growth. Not because firms are pessimistic, but because they lack clarity. This brings us to the central question. If markets are high and unemployment is low, why are institutional economists warning of a downturn? The answer lies in timing. Economic stress does not announce itself in advance. It accumulates quietly. Then it appears suddenly. The indicators that matter most often move last. Job creation data tells part of the story. While headline unemployment remains low, the pace of new job creation is slowed dramatically. Analysts note that employment is a lagging indicator. It reflects past decisions, not future confidence. When hiring freezes begin, the data looks fine, until it doesn't. Everything up to this point leads to one conclusion. The current strength of the U.S. economy is not imaginary, but it is conditional. It depends on assumptions that may not hold. It depends on policies being adjusted before the buffers run out. And it depends on confidence remaining intact. According to scenario analyses from Moody's Analytics and the Penn Wharton Budget Model, mid-2026 is not a random date. It is when three timelines intersect. Pre-tariff inventories are depleted, corporate margin absorption reaches its limit, and fiscal and monetary policy constraints tighten simultaneously. When those three forces align, price adjustments that were postponed suddenly become unavoidable. Start with inventories. Retail and manufacturing data show that throughout 2025, companies cushioned tariff impacts by selling goods imported before higher duties took effect. This is confirmed by customs records and earnings calls. Executives openly stated they were working through existing stock. That strategy buys time, not immunity. Once those inventories clear, replacement goods arrive at higher cost. At that point, prices must rise or margins collapse. Most firms cannot survive sustained margin collapse, so prices rise. Legal analysts point out that price transmission is rarely immediate. It moves in waves, first wholesale, then retail, then services. This is why inflation often feels sudden to consumers even when economists saw it coming a year earlier. According to Federal Reserve research papers, delayed pass-through is one of the most misunderstood dynamics in modern inflation cycles. Now add labor costs. Department of Labor data shows wage pressure intensifying in sectors most affected by worker shortages. These are not high-margin tech roles. These are foundational jobs tied directly to food, housing, and infrastructure. When costs rise in these sectors, substitution is limited. You cannot automate a harvest overnight. You cannot replace skilled construction labor instantly. Prices adjust instead. By itself, that would already be inflationary, But the third layer is financing. Treasury auction results and bond market spreads show growing sensitivity to inflation expectations. This matters because the federal government is refinancing enormous amounts of debt annually. Higher yields mean higher interest costs. According to the Congressional Budget Office, even a 1 percentage point increase in average borrowing costs adds hundreds of billions in interest expense over a decade. At that point, policymakers face constrained choices: raise taxes, cut spending, or tolerate higher inflation. Political incentives strongly favor the third option, at least initially. Economists call this fiscal dominance, when monetary policy bends to fiscal necessity. History shows this is where credibility erodes fastest. Once credibility weakens, expectations shift, and expectations drive behavior. Businesses preemptively raise prices, workers demand higher wages, lenders demand higher returns. This is how inflation becomes self-reinforcing, not overnight, but steadily. International investors are watching this closely. Capital flow data shows reduced foreign purchases of long-term U.S. bonds compared to previous cycles. Not a collapse, a hesitation. Analysts describe this as a warning signal, not a verdict. But warning signals matter. The dollar's strength is built on confidence in institutional stability. That confidence is not infinite. At the same time, geopolitical constraints limit easy fixes. Trade retaliation has already reduced access to key export markets. Agricultural trade data shows declining volumes to certain regions. Manufacturing reshoring announcements make headlines. But economists caution that factories take years to reach full productivity. The transition period is expensive, and it overlaps with fiscal strain. This brings us to employment. Forecasts from Moody's analytics project a widening gap between actual job growth and potential job growth by 2027. That gap represents lost opportunity, lost income, lost stability. It does not appear in unemployment numbers immediately. It appears in underemployment, reduced hours, delayed hiring, and slower wage growth adjusted for inflation. For households, this translates into a squeeze. Prices rise faster than incomes. Credit becomes more expensive, savings lose purchasing power, and the psychological shift begins. Consumer confidence surveys already show growing unease despite strong headline indicators. This divergence is historically significant. Confidence often breaks before data does. Retirees and near retirees face a different risk profile. Asset values may remain high nominally, but volatility increases. Fixed income purchasing power erodes. Healthcare costs rise faster than general inflation. And policy uncertainty surrounding entitlement programs creates planning risk. According to actuarial analyses, even small benefit changes have outsized effects on retirement security. Now consider the policy response window. If inflation accelerates sharply in late 2026, the Federal Reserve will be forced to respond. Rate cuts would worsen the problem. Rate hikes would slow the economy. Either choice carries pain. The question becomes distributional. Who bears it? Borrowers, workers, savers, or taxpayers? Historical precedent suggests the burden rarely falls evenly. Lower-income households are hit first by price increases. Middle-income households feel credit tightening next. Asset holders feel volatility later. This sequencing fuels political backlash, which further complicates policy coherence. Analysts call this the feedback loop between economics and governance. At this stage, it is important to be precise. None of this guarantees a recession. Models show a range of outcomes. A soft landing is possible if trade policy stabilizes, labor supply constraints ease, and fiscal discipline improves. But probability matters. And right now, risk-weighted forecasts show downside scenarios gaining weight. This is why economists describe the current moment as an experiment. The United States is simultaneously testing high tariffs, constrained labor supply, aggressive fiscal expansion, and politicized monetary pressure. Each of these policies has been tried before, not all at once, not at this scale, not in this global context. Supporters argue the payoff could be transformational. Domestic manufacturing, resurgence, higher wages, reduced dependency on foreign supply chains. Those outcomes are plausible, but they are long-term. The costs are immediate, and timing mismatches create instability. Critics argue the transition is being mismanaged, that sequencing matters, that credibility matters. That math eventually overrides messaging. According to independent analysts, the difference between Renaissance and recession lies not in ideology but execution. So what does this mean for individuals? Not panic, preparation, diversification, awareness. Economists consistently advise against binary bets on single outcomes. Economies rarely move in straight lines. They oscillate. Those who survive volatility are those who plan for multiple scenarios. Staying informed matters, not through political rhetoric, but through data. Reports from nonpartisan institutions are publicly available. They show assumptions, methodologies, uncertainties. Understanding those details is the difference between reacting emotionally and responding rationally. For policymakers, the message is sharper. Delays reduce options. Clear rules encourage investment. Credible institutions anchor expectations. Once lost, trust is expensive to rebuild. History is unambiguous on this point. As of now, the United States still has time. Time to adjust tariffs. Time to stabilize labor markets. Time to reinforce institutional independence. Time to align fiscal promises with fiscal reality. But time is not unlimited. According to every major model cited in this analysis, the window narrows significantly after mid-2026. The economy today feels strong because it is still running on momentum. Momentum from inventory buffers, from deferred costs, from optimistic expectations. Momentum fades, fundamentals remain. And fundamentals, unlike narratives, do not bend. This is not a prediction of collapse. It is a warning about probability. Growth can continue, but not on autopilot, not without course correction, and not without acknowledging trade-offs. The question facing the country is not whether the current strength is real. It is. The question is whether it is sustainable. And sustainability in economics is never about how fast you accelerate. It is about how well you manage what comes after the surge. The clock is running, the data is public, the choices are being made in real time, and the outcome will shape the economic reality of the next decade. This is not about fear. It is about clarity.